welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. But once in a while, we do look at generic issues, and that is what we are going to do today. We are going to look at rating agencies. Rating agencies are perhaps the most reviled amongst financial market intermediaries today, with almost every financial ill being laid at their door. As each passing day brings news of more and more defaults, and as a corollary, more and more rating downgrades, the question that comes to every right-thinking observer of the financial sector, and even to laymen for that matter, is what is up with rating agencies? Why do they get it repeatedly wrong? Are they sleeping on the watch? Worse, are they just incapable of assessing the default risks? And if that is the case, what explains the touching faith of regulators like RBI in external ratings? What is the role and responsibility of rating agencies, and how do we make them more accountable? Joining me in the discussion are three experts: Hemendra Hazari, the straight-talking banking analyst feared by most banks; J.N. Gupta, formerly with SEBI and presently MD Stakeholders Empowerment Services Private Limited; and Vibha Batra, formerly with ICRA Rating Agency and now founder CEO Fair Connect Business Advisors Private Limited. Welcome to the show, Hemendra, Mr. Gupta and Vibha. A recent report by Bloomberg says that rating agencies India, and that includes the likes of CRISIL, the Indian arm of global rating agency S&P, ICRA, the local arm of another global agency Moody's, and India Rating and Research owned by Fitch, Care Ratings, etc., continue to be caught off guard. Time and again, we have seen abrupt downgrading of ratings, and it is nobody's case that developments warranting such sharp downgrades can happen overnight. So, why do rating agencies, and presumably they have access to the best of systems thanks to their foreign parentage, why do they get it wrong repeatedly? Let me start with you, Hemendra. We will get into the details a little later, but for now a very brief opening comment. Hemendra?
In my opinion, there is complicity between the rating agencies and the companies that they are rating. Because I looked at IL&FS, I looked at Altico, and I looked at some of the Z promoter companies. And in my opinion, they never deserved an investment grade rating right from inception. So therefore, in my opinion, it is so glaring. You do not even have to be a complex financial experience analyst to look at the numbers at the time of the original rating. Even an ordinary student of finance could have pointed out the inherent risks that were showing at that point in time. The very fact that the credit rating agencies did not highlight these issues, which an ordinary student of finance could have highlighted, tells you that either they are completely incompetent or more likely they are complicit in the fact that they have to give liberal ratings, otherwise they would be out of business or they would be marginalized. And that, I think, is the heart. There is an inherent problem in their very business model because of the competition, and you always get some rating agency which is willing to give that entity a better rating, and that compels them, to keep their eyes closed. And this is what we are seeing repeatedly.
Mr. Gupta, Hemendra, as always, did not mince any words. But would you agree complicity, etc., are harsh words to use, or is it conflict of interest, incompetence? How would you see it, Mr. Gupta?
I would refrain from using the harsh word like complicity, but I would say compulsion is a more suitable word, that it is the compulsion of the business. And I agree with Hemend that the basics have been forgotten. Now, I have always been raising a question that rating agency always said that they have rated the instrument, not the company. Now, how can you rate an instrument unless until the repayment of that is either coming through a escrow mechanism or from the company? And since there is no escrow mechanism for each and every instrument, it has to be based on the rating of the company. That is one point. The second point is this: the basics of finance have been forgotten, because the first lesson that you learn when you do the analysis of balance sheet and profit and loss is that the current ratio has to be more than 1, and there has to be asset liability matching. You cannot have a long-term assets finance out of the short-term liability. Now, in all cases you will find that assets which have a long-term repayment of 30, 40, 50 years were financed from 5 or 6 year instrument, and since nobody questioned them, the 5 or 6 year tenure of liability became 3 month and sometimes overnight fund. Now, you were sitting on a potential time bomb. The moment one rollover fails, the entire system collapses, and that is what precisely happened. If you look at IL&FS rating history, in their last 6 or 7 years, they have got only one instrument rated from the CRISIL, and all other instruments were rated by ICRA, CARE and Brickworth.
Okay.
Now the question that comes, that if you are such a big company in the market, what is the reason that you are not going to the biggest rating agency? This again brings one basic question.
Okay.
Should we or should regulators say that like auditor and independent director, rating agency should also be necessarily rotated after some time?
Sure. We'll get into the details a little later, Mr. Gupta, but right now I just wanted an opening comment. So let me just move to Vibha. Vibha, as you can see, you're not going to get any support from the other panelists. But as somebody who has worked in ICRA rating agency for so many years and is familiar with the systems that they follow, is there nothing that is to be said in defense of rating agencies? Is it really possible, and that is what the fear is, that ratings can be influenced by one or two senior people within the rating agencies? So for the benefit of our viewers, can you very briefly explain the process that is followed in these rating agencies?
Yeah, thank you, Mythili. Difficult question to understand, and also ratings are extremely complex. So to briefly cover, so rating agencies are mostly aligned on sectoral lines. So when a rating agency gets a case, it's assigned to a team of analysts who work on the sector. They typically report into a QA or a sector head who has the company-wide or rating agency's view on the sector. So it's the responsibility of those analysts who are fairly experienced to look at the data and do the analysis and also the discussions along with the sector head. So what company feeds to the rating analysts in terms of data and also the future, and ratings are not at one point of time, unlike share prices which can go up 10-20% today and 20% down. Rating analysts are supposed to look at future and say that how fundamentals would remain under severe stress conditions, moderate stress conditions and not so stress conditions. So that's how, and then the ratings go to the committee. So each committee member has a single vote. Each of those are recorded. So even if you're a junior rating committee member, you may not agree, and all that is minuted pretty much like board minutes that you have. So the possibility of a single person influencing the rating, whether it's an analyst or a rating committee member or the sector head, is extremely remote. At the same time, ratings are dependent on the information that is given to them, and rating agencies are not fraud auditors or auditors. So they rely on the information, whether the past or future, that is supplied to them.
Okay, Hemendra, you just heard Vibha explain the entire ratings process. Are you satisfied that there are sufficient checks and balances? And is the problem, as you mentioned earlier, more with the ratings model in India, where there is a clear conflict of interest? You know, where the rating issuer is paying the company which is rating him, and so there's this hand in glove kind of relationship. So should we try some alternative models that have been tried abroad, Hemendra?
See, what she has explained is a very comprehensive explanation which works perfectly all right in theory. And anyone who has worked as an analyst or in media can tell you, in theory, all this is very nice. But in reality, all the people know that to survive in your job, you have to toe the line of what the leader says. So if you influence the leader, everyone else falls in line, and they fall perfectly in line, I may add. And let me tell you this, in the case of IL&FS, the consolidated company was loss-making for the last couple of years. Not only was it loss-making, it had a negative net worth for the last 5 years of consolidated accounts. Now, is not such a basic thing should be pointed out in the credit rating reports that come out, but I didn't see any comment. And this you can just make by reading the annual report. You don't even have to, get some confidential document. So it tells you the high level of incompetence, or, which I doubt, I say it is complicity, because they very well knew it was insolvent, but they could not, if they had highlighted, they could not justify an investment grade grading. So there is this inherent problem, and what is the solution here is very difficult, because just like in corporate India, where you have the role of independent directors are supposed to be watchdogs, I think everyone knows how compromised independent directors are. So the problem is no one is allowed to do their jobs, and that is the central problem. And this is not just for credit rating. You're seeing this on sell-side analysts, a profession which I represented. You're seeing this in business media. So this is what happens when everyone just toes the line. No one wants to stick their neck out and say it the way it should be said. And until you solve that problem, you can get all types of regulation in, but nothing else is going to happen. It will just continue.
Absolutely, Hemendra. You hit the nail on the head. But Mr. Gupta, SEBI and the Ministry of Corporate Affairs are reportedly planning to change the ownership and the governance structures in rating agencies to formally classify them as market infrastructure intermediaries. What will this mean for the rating agencies today? Because none of them meets the criteria for MIIs. Will it change merely by classifying them? And has SEBI been remiss in its regulation?
First of all, I do not agree that ownership norm for the rating agency needs to be re-looked into, because as you know, rating is a specialized business and it cannot be done by a bunch of people. You and everybody starts creating a rating agency. It will take a long time for us to acquire the expertise. That is one. The second, I would again reiterate, it is the business compulsion. In the entire rating industry, there has been a race to the bottom scenario for the business part of it. The issue is very clearly, as the panelist was explaining the process in the rating agency and Hemendra was countering it. I would ask a very simple question. When they say that sensitivity analysis of rating is being done, now can rating agencies say that they had carried out a sensitivity analysis of IL&FS finances and found that any trigger will not cause the collapse? The things are for us to see. A simple failure of rollover has led to a total collapse of the institution. The reason is because of asset liability mismatch. The other issue I am saying, the rating agencies have been ignoring the facts altogether. The fact that in the right issue of IL&FS, none of the senior management participated in the right issue, and 3 major promoters did not participate in the right issue way back in 2015-16, was a clear-cut indication that they themselves do not have confidence in the company. So I really do not know what to be said about these issues. Then you see the risk committee never met. Now all these issues are ignored by rating agency. I do not know what is as I always say, that valuation industry is again a magician's paradise. Similarly, rating agencies are a magician's paradise. They are some sort of a magician who, without knowing any figure or without going into detail, come out with a brilliant rating. And other issue is that many times rating agencies say that what can we do? We did not get the data. Nobody was putting gun to your hand had to give you rating. If you were not getting a data, you'd say, okay, I'm not issuing a rating.
So, Vibha, I think IL&FS is going to haunt rating agencies for some time to come, if not forever, because both Hemendra and Mr. Gupta said there were enough warning signals in IL&FS even without access to the kind of detailed information that you were talking about. So, what explains why rating agencies got it so terribly wrong? Is it because access to information, as you said? That could not be a case in the case of IL&FS, possibly in the case of other companies. But is that sufficient argument? And is the claim of rating agencies for more information warranted, or did they just fail on the job? Vibha.
Yeah. So, Mythili, here in case of IL&FS, I think there were a couple of issues. One, that rating agencies are privy to more information than what is available in public domain. Because ratings cannot be done at data available at one point of time, but how the data will look in future. So, in no way I am defending that AAA rating was right, but all I'm saying is that rating agencies have to maintain a balance between rating stability and also the being responsive to the changes. So, in case of IL&FS, fundamentals change very, very drastically. Over and above that, maybe initial rating itself was wrong. So, there was a methodology issue, and also being responsive to the market signals, they kind of delayed. But Having said that, I would say that rating, even if you were to kind of go back and try to fix those methodology issues, which by the way haven't been sorted out in the market. So holdco rating methodologies, you would be surprised to know that there's one Government of India holding company which was rated BB by one rating agency and AA by another rating agency. There is another holdco which is financial services, and I think issue Mr. Gupta raised that rating agencies raise instruments and not the they rate the instruments and not the companies, but in fact when the rating agency takes a view, it takes a view on the company's senior debt, who will be the senior most guy, and then the ratings are notched down for a subordinated debt. So in case of a very large rating agency, this rating, the methodology issue still persists. It rates a holdco's subordinated debt at AAA. So while we are getting into nitty-gritties of ALM and other issues, the fundamental issue is that we possibly SEBI needs to look at methodologies. Are they right? And also rating agencies need a reset button in especially financial services space where the external environment has totally changed. So a lot of ratings, if I were to go and get a new rating done, they could be in AA category, but they may not be even rated in A category. So possibly that kind of portfolio views, if rating agencies are not doing on their own, maybe SEBI should initiate it.
Okay, so we needed a reset button on the entire rating business, but I'm afraid it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Hemendra, Vibha tried to give some kind of explanation of what went wrong in the case of IL&FS. But you agree that the problem is partly the consequence of the seemingly blind faith that regulators like RBI have in external ratings. Today, ratings determine the risk premium, also risk weight, and in the case of IBC, the bankruptcy code, resolution plan has to be vetted by 2 rating agencies, but neither of them frankly has any skin in the game. In fact, in a recent article by Mr. Anil Kishora, DMD and Chief Risk Officer, State Bank of India, he pointed to the need to move away from complete reliance on external ratings and move to a mix of internal and external ratings to better alternatives. Would you agree, Hemendra, that's the way to go?
Most definitely. I always believed, and I've been debating with ratings and how they've been rating, with these rating agencies for the last 25 years. In my opinion, they are highly overrated. And when your own money is involved, you must always do your own homework. You see, in my opinion, it is not that there's a failing in their methodology. No, that was the time when, 25 years ago, I was arguing that there is a failing in their methodology. This is very clear that they're just ignoring the signals, because I'm seeing the same approach used for smaller companies, and they're pointing out some of the, things which they should have pointed out in IL&FS. So the methodologies are there, but they're just not, and deliberately they're not using it because they have to give it an investment rated, rating. And this is especially, we see these for large companies which seem to get away with it. So this is the inherent problem. It is, I don't think it's a problem of inadequate methodologies that they have today. They have it, but they just don't choose to use it. And therefore, it is everyone who's, actually investing in debt securities must do their own homework. They can just take rating agencies' input as just one of the many inputs that they have to take.
Okay, so that's a rather dismal picture that you're painting, Hemendra. But Mr. Gupta, the ministry seems to set great store by revamping the governance patterns of rating agencies. They seem to think that if you change the composition and have 50% of the board members as independent directors, there will be better management and governance. Would you agree, given the performance of boards in India, would you agree with that assessment, Mr. Gupta?
See, if that was the solution, then corporate India may not be or should not be having any problem, because there most of the companies have 50% independent directors. So it is not an issue that 50% independent board is a solution to all ills. So I would not agree with that. The second point, as Hemendra raised, is that the banks and other people should believe in their in-house. I would not agree with that 100%, because the solution is as bad as the problem itself. Why you need an external person is for 2 reasons. One, for independent view, and secondly for expert view. The problem happens when you take an independent view and you take an expert view and rely on it blindly. You never question them. The ideal way is this, that you have a rating given by a rating agency which is independent, and you have your own analysis. You should say that what is the difference between your analysis and what is the analysis of rating agency, and try to engage with rating agency what is their reason why their view is totally different from your viewpoint, and then come to solution. The second thing is that somewhere or other rating agencies must look into their system and rely more on the factual position rather than on a theory, because I again say, I will question Vibha very simply, that say for example, if I have bought a house which is a long term asset, borrowing from her and other 20 people on a 3-month basis, would she have given me money? No, she would not have given me money, because she knows that one day I am going to default. The same thing is happening in the infrastructure companies. All infrastructure companies have an asset liability mismatch, where 30 years is the asset and liabilities are 6 months, 1 year, 5 years, maximum 10 years.
So, some tough questions coming your way, Vibha, because as both Hemendra and Mr. Gupta mentioned, there is a fundamental problem with trusting ratings blindly. Trust but verify should be the bottom line. But is the problem also due to the fact that apart from the model where the issuers are paying for the rating agencies also provide non-rating services, and studies have revealed that issuers who took non-rating services from rating agencies were generally assigned higher ratings, exactly in the case of these, many of these multinational audit and consultancy companies. So, what can we do to ensure that this kind of conflict of interest does not happen? And of course, a question that Mr. Gupta directed at you.
Yeah. So, Mythili, I would like to answer the earlier question also, that Hemendra said that one should do their own analysis. I completely agree with him. So, if I am an investor, I would use rating opinion as an added opinion, and I would not do away with my own analysis on that. So, I think it's an added opinion that one should keep in mind. And second is, conflict of interest. Of course, rating agencies are in service industry, and some of the market signals, so the rating failure on IL&FS was possibly because rating signals were not, the warning signals were not picked up appropriately, and the public data that is available in public domain, you would see that the cases were going to rating committee quite frequently, but the rating actions were kind of delayed. So, it may possibly make sense to kind of insulate this issuer payment model, whereby because you are in service industry, you are not taking the right rating action at the right time. But I do not really have a solution there, because if investor were to pay instead of an issuer, then the rating fees would end up to be so low that rating agencies wouldn't be able to put enough high quality analysts.
So, Hemendra, what is the way forward? How do we square that circle of eliminating the conflict of interest? And at the very least, better ratings call for access to information. But according to a recent news report, the RBI is not willing to allow rating agencies access to RBI's borrower database, the central repository of information on large credits, on the grounds of borrower confidentiality. How valid are RBI's concerns, and could this be a factor that comes in the way of better ratings?
See, I don't think so, because the post-mortem analysis that I did of IL&FS, Altico and some of the Z promoter companies, it was very clear to me that sitting on the outside as an independent analyst, I could see enough warning signs. I did not require much more information to come to a conclusion. So, this is the demand for credit from credit rating agencies to justify their incompetence, that we always want more information. From what I have seen, with what information you have, you've not done any competent job at all. So, in my opinion, you have to take stringent and severe action against the senior officials of rating agencies. Mind you, none of them after IL&FS did any internal investigation. They did not sack their rating committee members who gave such atrocious ratings for IL&FS, and therefore it tells you that everybody was complicit in that system, and therefore it compelled the regulator to to ask for the heads of the CEOs of these organizations, because they failed to do that job. They should have immediately done a review and sacked those people responsible for that rating, but nothing of the sort happened. And this is what I see repeatedly in the private corporate sector in India. They refuse to take actions against senior people, and therefore the regulator has to step in and boot them out and if necessarily even file criminal cases against them, because that will teach them a lesson and that will straighten out all their practices.
Mr. Gupta, I think Hemendra wants a riot act read out to many of the senior management in the rating agencies, and he has a point. But the fact is that SEBI over the years has been tightening the screws on the rating agencies, but doesn't seem to have had much of a difference. So very quickly, because it's time for us to wrap up the program, what would you advise SEBI to do? Very quickly, 1, 2, 3 points to improve the entire quality of ratings and accountability of rating agencies.
First thing would be a little bit more transparency into the process. The second would be an advice to all the users of rating that rating is only a tool to aid you. It is not to substitute your own wisdom. And third, RBI's reluctance in the parting with the data of defaulters is a very intriguing thing. You want to protect the confidentiality of the person who is causing lot of problem to the system. What for? Why he deserves potential of confidential protection against leak of the data or release of the data for a person who is not disciplined. I don't agree with this. And lastly, I would say that RBI must also look into the issue, because rating agencies are at present regulated by SEBI, but who are the biggest users of rating agencies? Banks and NBFCs, which are regulated by RBI. RBI has not done anything to look into the rating process.
Absolutely. So I think, Mr. Gupta, you once again hit the nail on the head. Though rating agencies have not covered themselves with glory in the past, all hope is not lost, and provided the SEBI, the rating agency, SEBI and the Reserve Bank of India look sharp and try and improve practices there, I think the future could be less bleak going forward. Thank you so much, Vibha, Mr. Hemendra, as well as Mr. Gupta, for joining me in discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at TT Now.